All right, and welcome. It is now Friday, January 23rd. I am Todd Gordon. That's Kyle Wasson. We're Inside Edge Capital. Happy Friday. What's up, brother?
Happy Friday. Doing good. Just getting ready for the storm this weekend. So I've got to go do some stuff to make sure my garden doesn't all die and the chickens are warm and all that. So that's been secondary focus on top of a super busy week
Yep.
so far.
Yep. Kyle's in Texas. As you know, they're getting snow. We're in upstate New York. We're going to get some snow. Utah, Colorado getting nothing. Like, world's crazy right now. I mean, there's some parts of Texas are getting a foot and a half, right? I mean, do you know, has that
Yeah,
ever happened?
North Texas is supposed to. It's more common up there where they get snow. The strange thing is it's supposed to snow down here in Austin and like Houston might get some, which is pretty unheard of. It's hasn't happened in like 5 years. And then before that storm, the 2021, it had been pretty much my whole life. We weren't getting storms like this. So get ready for your
Here we
everyone,
go.
your southern U.S. friends to be overly dramatic about the weather.
All right, well, I'm going to be overly dramatic about this market because it's kind of
Yes,
bonkers. There's all sorts of stuff hitting us. Before we jump in, who are we? We are Inside Edge Capital. We're a wealth management shop featuring active, hands-on portfolio management, position management. We believe passive investing in the averages is for the average investor. He is the man behind fully integrated comprehensive planning, proactive tax strategies, which goes hand in hand with active management. And obviously, we like to conduct content, live videos as we share our thoughts with clients because I think there should be, in this kind of complex market and economy, there needs to be frequent communication. We are sharing our brainstorming process so our clients aren't surprised if and when we make moves, and nobody has all the answers. Our crystal balls are being repaired in the shop. The way I like to think of it, Kyle, is we move through the dark hallway forward, bouncing off the walls at times, but we still keep moving forward. And that's the best I think anyone can do in the markets.
absolutely. No one knows what's going to happen, but part of our investment approach and just our whole company's approach, it's, treating our clients like they were family. Some of them are family, and we try to do our best for our clients and run the type of firm that we would want to be getting run for ourselves and our family. So
Well said. And I was just texting with my parents. They're on a cruise. They're in Turks and Caicos right now. My dad sent me a picture from the Margaritaville restaurant and bar. They're in Turks right now, and I was thinking it's like nothing makes me proud, I would say, than to run my parents' money. Right? It's just all of our accounts are in the same. We're in the same models. When I do well on the portfolio side, we all do well. When I screw up, I feel it in my money, my parents' money. But I love being able to provide value and. Compared to
yeah,
where he was with a traditional wirehouse broker, he was like, this is night and day. So nothing makes me proud. I just want
yeah,
to share with that.
yeah.
What
That's why our services work because we are a fiduciary, right?
Yeah.
It's my favorite word, but yeah, it's acting in our client's best interest.
Yeah, exactly. All right.
Yeah.
Outside the markets, we're already kind of getting off topic, but we like to live the inside edge in the markets and outside the markets. I'm proud to say Jake, my oldest twin by 1 minute, finally won his first race, got a gold medal, beat everyone from upstate New
That's
York and Gore and Whiteface, couple of Vermont kids. He was so psyched. So proud dad
that's
there.
so,
In,
so cool.
inside edge. He was been working super hard. And the one thing, this is, I'm sure, as your daughter gets older, and we'll see if there's more in the Wasson family, but we're not naturally gifted in terms of athletics or intelligence. And I share that with my kids, Kyle, but I think how we win in the end is tenacity. And we're going to be there
Yeah,
to the bitter end. It's hard work, dedication trumps talent any day.
yeah,
And
yeah,
it's just that's the way I think we have to look at the market. So You know,
Yeah,
you're
my whole philosophy, it's like earnestness. We're gonna earn it. We're not
right.
just gonna get anything handed to us.
Yeah,
That's how we have been successful so far with the company.
exactly. Exactly. So
Yeah.
well said. All right. And then we kind of already hit on this one. And then Kyle's
Yeah.
news.
Yeah, it's just going to be cold. So again, us Southerners, we're going to be complaining. Like this meme here is when Texas gets an inch of snow and everything shuts down. The Texan is all serious and worried, and the Canadians are laughing at us. So it's just how it is. And then top right, we've got the Whataburger meme. So Star Wars reference there. And then my golden doodle in the bottom right. This is that last storm I mentioned when everything snowed so much and all the power in Austin went out. And we kept power, but we had two or three people, two or three friends staying with us just to stay warm because their places were completely out of power. So good
Ay, ay,
times.
ay.
Hopefully, it's not as bad as that this
I
time
don't
around.
know. This is looking pretty nasty. All
Yeah,
right. Oops. What happened? There we go. So here's what we're gonna hit. Here's what we have on the list. Sorry that this was started yesterday. That should be the 23rd. Maybe you can change that, Kyle. Obviously, we're
yeah,
gonna hit the macro. There's so much coming out of the World Economic Forum out of Davos. Speaking of snow, holy bananas. So I mean, we're just being pelted with headlines on the on the global macro, the geopolitical stage, as well as the domestic politics stage. I mean, it's certainly driving market movements, but as we'll show, I think it's driving a decision and the reluctance of bulls and bears alike to grab onto positions and hold. And markets trading in a very skittish manner. Data, Japanese yields. We're seeing a rotation out of the US into equities for reasons I just mentioned, as well as valuation concerns with the growth trade and AI. Breakdown of tech. We're going to look inside the technology trade as I blanketly say there's a big rotation out of growth. It's nuanced. Q4 earnings season next week is the heart of it. Lemonade, we're going to talk about that. Fixed income. We have a lot to hit you with. Okay, so here is the our bullish scale market outlook 1 to 3 months. We still remain on a positive one for a less than a 1 month time frame. 1 to 3 months, 2, and then longer than 6 months. I still think we're in a full-fledged growth bull market. There's going to be ebbs and flows along the way. That's why we're down to the 1 and 2s right here in the shorter time frames. But longer term, this AI bull trend is alive and well. It's not going to be a one-way stairway to riches. There's going to be volatility in there over the next several years, but I think there's generational, life-changing opportunities ahead of us. I really do believe that. And if I'm wrong, hey, I'll admit I'm wrong, and then put our active management hat on and go to work and
yeah.
protect. So,
See where the next wave is.
yep.
So on the economic side, there was a new consumer sentiment survey, which after bottoming out in September, October, I think the market was waiting for rate cuts that hadn't shown up yet, and until they did late last year. But consumer sentiment has been increasing since then, up by 6.5% from January to February. And then just a note about the consumer, I think with the tax refund, the tax bill getting passed last year, which preserved and expanded tax cuts. On top of last year, U.S. citizens are expected to increase their tax refunds by 50 to 20%. I've seen different numbers on the amount of like aggregate money that'll be, but safe to say that'll be in the hundreds of billions, and even saw a number that was over $1 trillion. So we shall see, and I do think that's going to bode well for consumer spending. A lot of these consumer stocks in 2026, just based on this. Obviously, there's other factors out there, rates and so on, but something positive. I think that'll help consumers this year.
Yeah, I mean that's quite a remarkable downtrend, Kyle, in UMich consumer
Seriously,
sentiment.
yeah,
Look at that, dude. From
yeah,
80, I mean, almost got cut in half consumer sentiment with the stock market at all-time highs. Like, You know,
Yeah.
it's
So
the headlines are scary out there, but I mean that little read
definitely.
you mish consumer sentiment, that's reassuring and finally seems like it's mean reverting.
Right.
All right, take me to Greenland. Greenland.
So
Greenland.
Greenland in the news, and I've never heard so much about, I don't think anyone's ever heard this much about Greenland before. It's just not an important geopolitical thing to talk about, but things change, and it's been in the news as Trump has his eyes on acquiring Greenland for the U.S. And so it has been, I think, first month of January, geopolitical headlines and all the everything surrounding that kind of took over the narrative. No earnings coming out yet. Fed quiet, things just kind of shifted towards the geopolitical side of things. And you can see it based on these two headlines just this week how the market appeared to have been trading based on, if you look at the 20th, so Tuesday after the holiday, um, markets were down sharply over 2% on news that Trump was considering using military action against a NATO ally to seize Greenland, was the rumor. He came out the next day during a speech on the 21st and said, we're going to negotiate to still try and get Greenland, but we're not planning to use military force. And then you see the market just rip back based on that news.
When do you
So
know, to put you on the spot, when did he walk that back and threaten European tariffs, specifically France? I don't know if Germany's in there. Do you know,
yeah,
was that the
it was, I think it was like Friday when he was talking about that, or maybe late last week, because he was saying y'all have until the first. Tariffs will go up on February 1st, and then they would go to 10% higher, and then I think 20. I'm just throwing out numbers, but
Yeah,
even higher again if we don't work out a deal by June. So I do think that got walked back, and market's definitely happy to not see additional tariffs on top of the existing Europe tariffs, which were already higher than they were before Trump's second term started.
right. And he's been doing this. He kind of makes a bombshell headline, bearish news, market reacts to it, and then a day or two later he comes back and just kind of undoes it
Yeah,
or almost contradicts himself. He's done it several
yeah,
times. I know with the industrial stocks.
yeah.
Was
I
it?
I think it's an art of the deal
It's
thing.
got to be an art
I
of the
read
deal
that book
thing.
a long time ago, but if he's making a big global speech, what better way to get people to listen to him than to say something insane the day before that?
It's just so true. All right, keep going. Let's go to Switzerland.
So yeah, Davos had a lot of pretty much all the important power players in the world there in Davos with the World Economic Forum, headed by Larry Fink, right, the former Blackstone CEO, now running the WEF. We had Trump. He, like I just mentioned, he is willing to negotiate for Greenland. I put Europeans in NATO. Just a quick aside: Trump and Mark Rutte, the NATO chief,
Okay.
actually were negotiating Greenland and not Denmark and Greenland. So Greenland and Denmark were not invited to this discussion, which I
Oh,
thought was a
really?
little strange. But yeah, they Rutte and Trump were talking about some sort of outcome they were looking at, and I'm like, isn't that Denmark and
Yeah, but
Greenland?
I
Isn't
think
that not?
Trump's point of view is as far as I
He
understand
did.
it, we gave
Yeah, that's
Greenland
his
to
view.
Denmark after World War II, I believe.
Right, right. But
So,
just interesting
uh,
note that it's just who knows, and I'm giving it any news on Greenland
but
48 hours before I take it seriously. But
but I think we have
but
to
yeah,
I think we also have to play the other side, which is it's easy for us to be like, headline readers and kind of roll our eyes at what Trump's doing in the headlines. But I mean, there's plenty of evidence to suggest that, Russia has, rolled nuclear subs in there close, a little too close to where, is
Yeah.
acceptable for us. So it's not so much a
Yes.
rare earth mineral play. It's a military strategic safety play,
Exactly.
which from
Yeah.
what I've read, I mean, China and Russia will be all over that if he's not. So
Yeah.
I think we have to
And
look at it with an open mind.
definitely, Russia has been doing its thing in the Arctic Circle with expansion and really open maritime law is a lot more flexible on what a country can do in the open waters. And China's a lot of reports of them overfishing around the world. So
Yeah.
yeah,
Oh
I
yeah.
do
Yeah.
think there is some geopolitical aspect there that definitely needs to be respected.
Copy that.
So
Copy that. Keep going.
yeah, Trump talked about a lot of domestic issues, which you can read. He called to ban institutional home purchasing and cap credit card interest rates at 10% a year. So some things to help consumers. Him calling to do these things, it didn't change anything. I think Congress would have to act to do either of those things.
Yep.
And then also some critique on Europe and Canada. Elon Musk was there. I read it was his first time to show up to the World Economic Forum and he did a discussion with Larry Fink. I thought the most notable thing was his continued predictions of a post scarcity economy. And he mentioned more humanoid robots than people. Noted that at this point, his humanoid robots, so not giant industrial machines that are in a line, but actual humanoid robots that walk around and function with arms and legs. They're doing simple tasks in his factories already, and that by the end of this year, he expected them to be doing complex tasks. So just an appraisal, I would say, of where the humanoid robot technology is at this point. It's still coming along, but also still promising. And then Elon Musk being Elon Musk, always talking about travel goals and space travel in the future. Fix a typo there. He joked about dying on Mars, quote, just not on impact. So that was kind of funny. Um, and then, yeah, just an optimistic, forward-looking, futuristic vision for humanity, which I think is what makes Elon great. He's not someone that could be put in a box and just kind of take things how they are. He's always looking towards the future, which is why he has the respect of so many investors and other people.
Yep.
And then on the kind of the more dramatic side, Mark Carney he's the Canadian Prime Minister. For anyone who doesn't know who that is, he declared the international rules-based order was always partially a fiction or a lie that was actually selectively applied by powerful nations. So kind of a attack against the U.S., I would say.
Yep.
He urged new national alignment for Canada and the rest of the world based on, quote, legitimacy, integrity, and rules. And then this speech he gave also came on the heels of a new economic partnership with China. So we are seeing things kind of shift on alliances and just around the world, which leads into this next slide pretty well because a term we've been seeing thrown around a lot more is a multipolar world. If you listen to the Chinese foreign minister, I believe, was also at the World Economic Forum. It's a term he used a lot. You can see a chart here showing the United States, EU, and then the BRICS nations. So Brazil, Russia, India, China, and then South Africa should be highlighted down there. But that economic union that kind of got created as the U.S. departed from free trade policy sometime in the mid 2010s. So that's just a theme that we keep our eye on. We trust corporations to be ahead of these geopolitical shifts, managing their supply chains. Some of the smartest people in the world running these companies, we expect them to navigate it, but it does create some fluidity in markets and supply chains, and and everything in between. So just something we recognize and we're watching.
Copy that. Well done. Well done. All right. So let's shift off of the geopolitical stage. Let's get into the domestic equity markets. Those of you who've been following us for some time are probably as sick of hearing about this consolidation in the US stock indexes as I am talking about it and observing it every day. And what I find is, over the years, particularly as the markets don't know how or what to make of the crazy geopolitical, domestic political headlines and fundamental headlines, when people throw their hands in the air and say, I have no idea where the market's going, frustrations at peak levels, is when it finally breaks. And I feel like we're getting to that point. So I was on CNBC yesterday talking about our cautious approach to our portfolios, particularly in our growth portfolio, which is TAG, Tactical Alpha Growth. That's our flagship growth. And then Active Ops, which is our fast money, super quick in and out portfolio, where we did put an option hedge on. So on CNBC, I was talking about that. I leaned into it quite a bit by setting the stage with all the confusion out there, as Kyle just did such a good job of laying out the geopolitics, as well as, domestically, the rotation that I'm going to talk about that's led the NASDAQ here to be in a range that is pretty much the same price since October of 25. Okay. So you can see, we've got a pretty flat top here in the NASDAQ. This is the QQQ, the ETF that tracks the NASDAQ 100. Rising bottom. At some point, man, the ceiling is cramping in, the floor is coming up on you, and we're going to need to break. Now, the one thing I would look at is if you divide the SPY, actually, this is Qs and SPY. This blue and purple line is the relative strength. And basically what it's showing is the NASDAQ over the last couple days is starting to outperform the S&P. So that might mean a little bit of a resurgence in growth. I have a hedge on, as we'll talk about. We might not need it in the active ops. If we lose money on it, that's fine. That's what a hedge is for. I'd rather have fire insurance that goes unused rather than having to claim it. So as I mentioned, we have a hedge on an active ops. This is the actual screenshot of the position. So we bought a 595, 565 put spread. And basically what that's doing is that $30, which is roughly 8% of the NASDAQ, is protected, right? It's a $30 spread. We paid about $6.50. The profit would be $30 or $3,000 per spread minus the $650 you paid. The difference is your max profit. So we have a hedge on. The other thing that we've talked about is we did on December 17th, as the market was in this really tight range, is raise about 20% cash in TAG, which is our flagship growth portfolio. So that was right here. Was it a reactionary move? Yeah, maybe. We rallied from it, came back, retested, and here we are again, threatening a break. So we're carrying 20% cash right here in BIL, which is a short-term treasury ETF. And every single day I'm watching, do we redeploy, or will the headlines in geopolitics that are so much driving this market even overcome earnings now that we're in Q4, push us to lower prices as that technical pattern is coming to maturity, and we'll need to make a decision. We'll have to see. So some of the things I talked about on CNBC yesterday that are leading to the indecision and our decision to make a hedge is we've seen a rotation into small caps. Now, is it Trump's domestic policies? Is it rates moving lower that would favor lower borrowing costs for non-large cap, mega cap companies that can just issue debt in the private markets? So the small cap Russell has been rallying, breaking out. So this is the Russell compared to the S&P, clearly an uptrend. So small caps are leading right now. Will it sustain? We shall see. Now, I won't go into it on this one, but a lot of the stocks that are pushing the Russell up are like growth stocks, AI stocks that are still considered small cap. So small cap stocks will eventually graduate up to mid cap and leave the Russell 2000, which is why it's always kind of a broken index. All right, we're also seeing a rotation into value, okay? Value and cyclicals. Now, let's look at the year-to-date return on the 11 sectors that make up the S&P 500. This is year-to-date. It's January 23rd. Energy is up 10.6% this year. Energy's had a year's gains in the first 23 days of the year. It's interesting. Energy, and looks what's behind it, materials. Industrials, which is good. Staples, that's defensive. Consumer discretionary, real estate, healthcare. Here's the NASDAQ. Here's the S&P. Tech is leading both the S&P. Tech is lagging both the S&P and the NASDAQ. Utilities, comms, and financials. Okay. So we're clearly seeing a value or cyclical driven component or area of the market that's leading us. This is a 1 month return. So this is going back to December 23rd. Up 25%. Silver miners, oil and gas, Bitcoin miners have come back. Gold, steel, semis, materials, genomics, solar, home construction, and aerospace. At the bottom is software, casinos, medical, cybersecurity, airlines, utilities. So it's a fractured market in here, and I'm going to continue to make this theme to drive home the point of this. Energy is very interesting. This is XLE. This is the sector ETF that follows the largest energy stocks in the US. The XLE has been in consolidation since 2022. This is the weekly chart going back all the way to 2014, and we're coming up on the old high. Kyle, we're looking at a 12-year high in XLE. Now, it's really interesting with what just happened in Venezuela. Trump said he's going to sell the, 50, do you know offhand, 50 million barrels? Is that correct that I heard?
I don't know. I know
Okay,
they're one of the biggest reserves of the type of oil that the U.S. refines. So
right.
it's a natural partnership there.
Right. So yeah, they have heavy sour where I think we're lacking where we're flush with
Or
light sweet.
sweet. Exactly. Yeah.
Yeah. So XLE's breaking up. And you know what? Not breaking up, breaking out, I should say. And I'm having good memories because when we launched in October 21, which was right here, the inflation trade was raging into 22. And we got on board XLE energy stocks and did quite well to start out, when we launched Inside Edge. And here we go on the weekly as well as the daily. We're starting to break. So combination of deregulation, even with flush supply of oil, the idea that fossils are certainly not going to be so easily replaced with EV. Nuclear is going to take a long time to come online through red tape as
Yeah.
well as just the infrastructure to build. Really interesting with
And
energy. Go ahead.
no more solar credits. I mean, if you look
Oh
at it
yeah.
as a competing energy source, I mean, if wind and solar credits go away, that's not necessarily gas, but natural gas would benefit.
Yep. Yep, exactly. So we're going to be watching that XLE and XLE into the SPY right here. The ratio's ripping. So energy's leading. And the fact that it's up 10.5% in the first 23 days of the year, interesting. And then you put this cherry on top of a 12-year breakout in XLE, we might need to be looking up our exposure in energy. Just kind of a fun scan for you traders out there. I'll show you how some of the sausage is made. So scan that we did. Stocks above $10, billion market cap or more. It's in an uptrend with a 50-day above the 200-day. EPS growth expected next quarter to be greater than 10%. So I guess it'd be Q4 of 25 if the energy stocks have yet to report are greater than 10% of the EPS from 24 in fourth quarter. So growth is more than 10%. Return on equity, which is a great metric for value and cyclical stocks, above 10%. Energy and the average EPS growth of the last 3 quarters is above 10%. So here are your names, and there's some nice ones with some good yields in there. You're in a technical uptrend. You have good fundamental ranks, EPS score, as well as some of the technical metrics with earnings. And we have some really interesting names that we can look at in here. VLO, I know that one is very much involved in Venezuela. You've got PBR, Petrobras, a few other ones. DHT is good. And then this one I really have my eye on, AROC, Artrock. 3.31% yield with really solid numbers. Good chart on that as well. So, okay, Kyle, if you closed your eyes for a minute and I asked you, I was shocked by this. 1 year change, growth versus value, who would you say has the edge? I don't know if you're looking or not. What would you
I
say?
am, and I already know the answer to that question
But
of
are
the
you
lead.
shocked to see this? Over 1 year, growth has
Yeah,
got a 0.5% edge on value, and we're in an AI rally. I'm like what?
yeah. It's to me, it's like all the value just caught up though, right? If you go back any
Yes.
further, you're going to see the chart reveal the starting points, which growth had
Fair
already
point.
been
Fair point.
rushing.
Fair point. You go 3 to 5 years, growth is way ahead of value, but over the last year,
Yeah.
they're right on. We even had a big spread here. Growth was up 19% and value was up 6 or 7. And that rotation that we talked about since October, the consolidation in the index that I've been
Hmm.
complaining about is evidenced by this value closing the gap on growth.
Yeah, and it was nice to see in October. It was nice to see some of these growth rotation out into other equities and not cash, you know.
Yeah.
So it
Okay.
wasn't
Good.
like
Good.
people
Good point. Yeah.
were giving up on the market. It was, you know, all these value stocks might be a little cheap compared to these growth stocks which have outperformed for so long, and it
Yep.
just it made sense.
Which is a big argument for the small caps. And I know Tom Lee is looking at that.
Yeah.
All right. So year to date, 23 days in, Vanguard value is up 3.34% and growth is down 0.81, which shouldn't be any surprise there. So this is another thing I had, every time I go on air, I've got 4 hours of notes and Kyle's like, Todd, you like machine gunned it on the open. He's like, why don't you pick 1 or 2 points? That's the feedback he gave me on air, which I'm like, totally fair. This is one of the things I really wanted to get into. I'm like, yeah, the NASDAQ is sideways. Growth trade is on par with value over the last year. Value's up 23 days into the year by 350 basis points above growth. But look how fractured the tech sector itself is. So this is a 3-month change going back to October when the range started, right? Semiconductor, it's so like it's easy to say, well, growth is over. Semis are up 16% in 3 months, the
Yeah.
SMH, right?
Micron.
Hardware, what's that?
Micron, just with all their
E-
everything, all the growth there.
Right. It's like it's Micron, it's WDC, it's SanDisk, it's the storage, it's the hardware stuff. There's not even an ETF for tech hardware. I had to go to this Fidelity mutual fund. It's FDCPX is up 6.61%. Mag 7 is up 2. XLK is up 0.5%, and software is down 14.6% in 3 months. Like, look how crazily fractured the tech sector is. Like, that's Microsoft way off. Adobe, even Palantir is flat. Like, Microsoft has
Yeah.
come off hard. Like, the software stocks,
Yeah.
because of the onset of AI, are really hitting that group, and probably rightfully so. So I think that's really, really interesting that, as much as I like to say growth is rotating out, semis are up 16% in 3 months. Nothing? Keep rolling?
Yeah, I mean, we always knew it was like there was going to be some over speculation in AI, and it'll hit at different points. Wouldn't surprise me if software comes ripping back, and if semis eased up again. Like
Yep.
it's such a fluid market.
Yep. And I wonder if I don't know if Meta is in that IGV. I just picked up Meta in the active ops. I don't know if Meta is in there or not, but I feel like Meta, I think, is trading 22 times 2026 earnings, so cheap. All
Hmm.
right. As I mentioned, also, like, we're seeing a huge rotation overseas, and this is real. So this is year to date. This has been happening for several years, but this is year to date. We have Peru, we have Colombia, we have the U.S., South Korea, Taiwan, Chile, Brazil, Mexico, Argentina, and Canada. EPU is Peru is up 20%, 23 days in. EWY, that must be South Korea,
Yeah, I think so.
Colombia, Chile, Brazil 14%, Taiwan 9, Mexico 8.6, Argentina 6.4, Canada 3.2, and the SPY 1%. We've begun to rotate overseas. We've got some South American, Latin American exposure. We probably need to get more. China is starting to come in. We're seeing pretty good moves in like Alibaba, Baidu. We're definitely seeing rotation, and I'm selective in what equities will hold overseas. I would prefer to hold ETFs to sort of spread out the individual company risk, but I'm very much watching this rotation overseas. Okay. We also have Japan. Yeah, Kyle's going to hit this one. This is interesting. I've been watching the Japanese yield rip higher from almost zero in 2022 to 2.26%. Japan has been mired with deflation because of demographics, slow innovation, which I think is hopefully changing, and they've been struggling to get out of the grips of deflation. Well, now they have inflation, rates are rallying, and that's kind of throwing a shock in the macro market. Kyle, pick it up for me.
Yeah, so implications there with yields hitting a 27-year high on the tens, and I think longer term yields are reaching records for yield, I want to say. But it's just been pretty, pretty unprecedented, or 27 years since we saw it. And what are the implications? Anyone who understands the yen carry trade would know that this higher domestic Japanese yields could take away that delta between the cheap funding you used to be able to get, and then go reinvest it for a higher yield, kind of an arbitrage opportunity that is, I would say, at risk as rates go up. And then
And that's the carry
just
trade right there that you guys have all heard.
exactly, yep. And then just that might carry over to more repatriation of Japanese capital, which is pretty huge, third biggest economy. Japanese capital coming back in from uh, U.S. Treasuries or U.S. stocks or other global investments. So um, I guess the question is this bearish for the Nikkei equity index?
Good setup. Good toss there. Well, here's the
Right.
S&P and the Nikkei going back to 20. This goes back to actually 2017, April 17. You could see the correlation 17, 18. There's COVID. We rally up. Nikkei's flat. So far, the Japanese stock market bull trend is very much in play, along with, as I said, the rotation in international equity. So far, the spike in yields in Japan, as Kyle said, repatriates the yen back into Japan. In my old days, when I used to trade in the FX hedge fund, when the yen was rallying, the impact on the macro stage was that's a deflationary signal for the world. Deflation is bearish for equities. That's not really that's not really manifesting, I should say, right now. So something we got to watch. I do think the BOJ, Bank of Japan, is engaging in yield curve control. They're going to have to stem that sharp move higher in yields. But while the Nikkei continues to push higher, I suppose it's good for now. It's okay for now, but it's a situation we're going to have to monitor.
Yeah, and it's the yen it's flirted with 160 a lot, but it just has it's bumping up against it now. So I think that's probably a resistance point if you are looking technically.
Yeah, good point. I should have thrown the dollar yen in there. Let's keep moving though. Let's pull it back to U.S. yields. As I said, I've been hammering the table on the consolidation, triangle consolidation, higher lows, lower highs in the stock indexes. U.S. 10-year yields, which is the benchmark yield in the U.S., has been in a range now since 2022. So highs are getting lower, lows are getting higher. We're coming to a point. I mean, we don't have to break out right away, but at some point there's going to be a move. Which way? I don't know.
Yeah.
Kyle, what say you?
I wish I knew, but interest rates and yields are so hard. They're so multifaceted. They're dependent on more variables than you could probably fit in a formula. It's just it remains to be seen.
Well, yep,
I
I
think the
agree.
long term, very long term average is 4.6
Mm-hmm.
on the 10-year, so still under that. But more recent, 10, 15-year average is going to be lower than that, as we saw like during the mid 2010s and back during the pandemic and other periods of
Yeah.
slow economic growth.
And there's two things to keep in mind here. One, we're still running 2.6, 2.8% inflation on the latest PCE. So your real interest rate, your real cost to borrow is 4.24 minus your 2.6%, yield. So it's still, the
Yeah,
real rate is still low, number one. Number two, this is probably the first presentation, Kyle, that you and I have done in 2 years that doesn't have that stupid Fed funds probability rate
yeah,
calculator.
exactly.
It's probably the first one that we've left it out, right?
It's always on there. Yeah,
It's always on there.
probably.
And because the Fed is on hold until June. Like when
Hmm.
I mean, there's no the Fed funds has got no chance of really hardly any chance of a rate cut until June. So the Fed's out of the picture. Real rates are two
Yeah,
and a half or whatever, 2% right now. It's fine. Maybe yields are right where they should be. And we're just going to chop sideways, and maybe we can stop talking about fixed income and we can,
yeah,
have our clients go collect a 4.25% 10-year nominal yield. And maybe we don't have to obsess over it like we have since the pandemic when fixed income went crazy and we had the worst
exactly.
bond market in, the worst year for the 60/40 equity fixed income portfolio in how long. So
Since
things
the
seem to
late
be
70s.
stabilizing.
Yeah. Yeah, it could go either way. I mean, if you look on one side, and I know how unhelpful that is, it could go either way. But
Yep.
on one side, you have tax refunds, you have overseas profits getting repatriated, hundreds of billions. You have the government continuing to spend a lot of money, which can drive inflation and rates up. So I think there's a strong argument that rates could go up again if
Hmm.
the economy is still hot. I could totally see that. On the other hand, if the economy slows down at all, the Fed's going to cut rates like you saw back in 20. It's just a
Yep.
straight cliff. The
Yep.
second the economy gets bad, Fed's going to cut. They're going to try and cut rates to help people out. So it's an
And
inflection point.
it is. And I think to your point's a good one on if growth really starts to pick up, the Fed can raise rates to combat out inflation. But I feel like if we go into another growth stage, it's going to be tech driven. It's going to be growth driven, which technology is inherently deflationary. That argument has been out there for a while. We're starting to see signs of it with AI replacing, a lot of workers, increasing operating efficiency. That's why valuations are higher. Like tech is
Yeah,
deflationary. Companies can
like
act, they can be much more lean and increase profit margins. Go ahead.
definitely. I was just going to preface, but like with lemonade,
Oh, okay. Yeah, we'll talk about,
lemonade
yeah.
stock. Yeah,
Great one. Yeah,
but
yeah.
yeah, we'll get to that.
We'll jump into that one. Okay. Talk to
So
us. Kyle runs a fixed
yeah,
income
so
portfolios here at Inside Edge. That must be the bell is ringing in my ear.
must
Must be
be
four
3 or
o'clock. Yep.
4. Yeah. So we did a name update on our fixed income model to better align with how we are managing this model. So before it was called fixed income, it was restricted to just fixed income holdings, different types of bonds, corporate, government, etc. Our process has evolved based on some of that yield uncertainty and volatility, which we were just talking about with where rates go from here. If you look at the chart on this is our model performance on the top right. Um, like we mentioned, worst bond market in 40 years. We managed to keep performance above the benchmark, so above the US aggregate bond index. Through that decline, I took over management of this model when I joined in late 2022, seeing the drop off from the rate cut or rate hike, I should say, because the new bonds were paying more yield than the old bonds. It made the old bonds pretty worthless comparatively. So when I started, I recognized that. I knew that there would be some bounce back, which we saw in late 2023, especially. So as rates go down, the new bonds then aren't as worth as much as the older bonds, which were paying more, the ones that would have been written from late 22 to late 23. So that's that spike there in late 2023. And then at that point, I kind of said, that I was in my head. I said, I don't know, rates are so uncertain and I don't really want to play that game anymore. So I looked at alternative, more fixed income like holdings, things that were giving higher yield, like high yield, as Trump got elected, very pro business, very accommodative. We saw even during Biden, we saw bailouts of those banks, Silicon Valley, so, high yield debt seemed like a safe bet. Into 2025, I also bought some fixed income or some precious metal for the fixed income model. And so it's evolved. We want to deliver price stability and consistent income. Bonds aren't always the best avenue for that. And we also wanted to use this model to complement our equity allocations that pretty much all of our clients are in. So, what type of defensive model works best with someone who owns stocks? And what that looks like is what's historically inversely correlated to stocks and longer term duration bonds, as long as you have a good entry point, are a good way to hedge and to inversely correlate to stocks in the case where the market slows down, GDP slows down, and you see stocks get hit. Long-term bonds would then go up as the Fed lowered interest rates to fight that economic weakness. So longer-term duration bonds are good as long as you buy them at the right time. And then precious metals, we did see a high correlation with silver and gold and the stock market, but historically it's not like that. So we do view them as sort of a hedge and an inversely correlated security.
Right. And
So
the
yeah,
real fear in what you just said is key. I mean, if in a normal market with the elevation that we have, probably if we have a good old fashioned crisis or something, the Fed can lower rates, which would boost bonds. The problem with 22 is stagflation was the big fear, which is high inflation post pandemic with that drastic fiscal policy response out of the government, flooding the
yeah,
economy with cash, with a slowdown
exactly.
because of the shutdown. That's stagflation. And the Fed's like, we can't cut rates because we're already in inflation with slowing growth. And that's why bonds got crushed. If that happens
Yeah.
again, okay, 60-40 portfolio bonds get crushed, but probably not. If we have a good old fashioned crisis, which we don't want, as Kyle just said, the Fed can cut rates. Do I kind of have that right in my mind?
Yeah, absolutely. So stagflation, we would want to be getting out, even though the market would be slowing down. That would be where the government or the Fed is just pumping money in as much as they can. On that point, we would be looking to get into inflation protected bonds, which we were in 2022. That helped with the downside there.
Yep. Yeah. And I had, before you joined, I had tips in the fixed income portfolio anyway.
Yeah,
And I know you've been doing an excellent job managing that bond portfolio. So well done, dude.
yeah. And yeah, just one more quick thing I noticed. I mean, to illustrate the taking the volatility out, if you do look on the late 2024, you see a rise in price and then a decline. If you look at how much the US Ag, which is in orange, went down compared to our model, that's just a good way to eyeball how
All
we've
right. All
decreased
right.
the
All right. Good job. You
volatility.
did a great
Yeah,
job.
it's okay.
You,
I'm
you,
medium
you
happy
already,
about
you
it.
already got a really good bonus. Good job.
And
I'm
we'll get in more. Well, I want to talk more about it, but we'll save it for clients only presentation next week.
well said. Well said. All right. Keep going. Great job.
Yeah, so just on that same, planning, I'd mentioned how this model, strategic income and stability, would complement someone who or better complement someone who also is invested in equity. There is this whole discussion in our strategy process with clients around where does the planning meet how we recommend you invest your money, and then hopefully go forward with helping you implement that plan. But what this is showing is how we use software to decide the ideal investment breakdown between your account or between your whole portfolio. So base financial plan here in this table, if you're looking, this is assuming we didn't change anything. So client brings in a list of investments, nothing's changed yet. We run our analysis assuming nothing changes, and we can show them that there's a 95% chance that they would never run out of money based on how they live, how much they're spending, how much they're distributing from their accounts. What we can then do with our software is look at making adjustments. So the second row here was a scenario where we left everything the same, but we invested their accounts into a 25% equity, 75% more defensive allocation. You can see the success rate go up by 1%. Same story if we did 50% into equity, and we can also show in dollar values, both in future dollars and today's dollars, what the potential, or what you could say the opportunity cost of not investing or not
And
updating your
equities.
investment plan would be. And you can see in a base plan where someone's more heavy cash, you're looking at a very capped upside potential. And then what is that 2% success rate between 95 and 97%? That 2% is the individual losing their purchasing power in a high inflation scenario. So it's, they're outliving their money because they didn't keep up with inflation in those scenarios. And then just the last two here, say this client wants to retire as early as possible, maybe before they're 67, before they reach Social Security age. We can also run analysis and show, you can invest safely, 25% equity, showing an end of 2027 retirement, 50% equity, got more growth potential there. So actually a successful plan would be a year earlier should you invest a little bit more in the market. So using historical returns, using different variables that can be changed, and based on the client's preference as always, what they want to do with their life, their retirement, their savings, just putting it into numbers and seeing what works.
Absolutely. All right. Do
Yeah.
we Okay, go ahead. Yeah.
We can probably skip forward pretty quick, but it's just more same graphics, but just more points about how we do our financial
Yeah,
planning. There's also
let me
really
jump
advanced tax planning that we
let me
can do.
jump in. We need to isolate the planning aspect and the software we use. But let me just pull this part together. But if we go into the stock spotlight, like I can't tell you guys, if you're still listening, please drop a comment right now if you would. Just say, "Yup, I'm listening." And I'm particularly talking to traders who we have developed, we've kind of niched out and carved out a niche to the active trader who I think has a hard time perhaps getting their financial plan and understanding their risk tolerance, their goals, and bucketing out their trade income from the long-term investing account. And we've seen some very smart, accomplished people who kind of adversely or negatively commingle the two, costing them
Mm.
valuable returns. So it's like if you're a trader or someone who's actively invested in the market, going through a financial plan with Kyle, who knows how to speak to traders because he's spoken to hundreds of them that one-on-one that have reached out to us, like especially for you, successful, intelligent, your brain never stops, you overthink things, which is great, which has made you successful in other areas. When it comes to planning and bucketing and compartmentalizing your risk and what you're trying to do, what your different goals are for your accounts, it's so important that you go to a planner who understands traders. Is that fair? Can I leave it there, Kyle?
Definitely. Yep. Well said.
All right, yeah, we'll definitely come back and hit that one more. So good stuff. All right, we're just taking in all kinds of different directions. Earnings, we're in Q4. Next week is the heart, beginning in the heart of it. We've got UNH, we've got Boeing, we've got Raytheon, Energy, Union Pacific, ASML, which we are holding in active ops, Starbucks, GE Vernova, AT&T, and then Wednesday we got Tesla, Microsoft, Meta, ServiceNow, IBM, and Lam Research. So earnings are here. Thursday, MasterCard, Cat, Lockheed Martin, Altria, SAP, Blackstone. Apple is going to be Thursday. Visa, KLA Tencor, which has been ripping. Chevron, that's going to be a good one. We hold that. AXP, Exxon, and Verizon. So next week is going to be earnings season. Maybe earnings will start to trump the mass amount of macro headlines that have been assaulting us all week and keeping the stock indexes so tight. We mentioned an AI play that is disrupting potentially a 120-year-old industry, which is the insurance industry. So this is the Inside Edge Capital Stock Spotlight, Lemonade. All right, so this is an AI-based insurance company we hold in active ops and tag. The company on the website claims we as Americans spend more on insurance than we do on AI, defense, electronics, education, and oil and gas. So Lemonade is a combo value growth play. It's a new age AI stock that the four pillars of the company, of an insurance company, have all been built from the ground up. It's a custom solution. It's not like a patchwork, like pulling in different, LLMs or different software programs to make the company. This was built from the ground up. It's got a history of coming to market, I think in 21, sold off in 22 and 23 while I was building the AI. So the four parts of insurance company, I had to study this before I could invest in it and present it to you guys. Customer acquisition, policy pricing, claims processing, and fraud detection, all AI based. Happens in real time, claims paid in seconds, underwriting updated in seconds. Compresses operating costs, as loss ratios are being compressed, right? So not so much, I don't want to call it fraudulent claims, but superfluous claims that really aren't based on anything. The company can go quickly root those out. You look at the revenue growth from 19, 20, 21, you can see it's very slow. That was the big sell-off in 22. And then we started ramping from 400 million, 500 million. We're expected to go 700, 1.1 billion, 1.5. You can see the percent gain. The revenue growth in 26 compared to 25 from 727 million to 1.15 billion is a 59% year-over-year rev growth. The company is also looking to go free cash flow positive next year, which is interesting. So you look at the negative free cash flow from 21 to 25 and then go up and generate $100 million in free cash flow, which is a massive percent gain, and then go up to 180 million to 300 million of free cash flow. So the company's looking solid. I liked it. When Kyle was coming into the city for CNBC in December, I was planning to do Lemonade from the New York Stock Exchange floor. CNBC, the producer called me. They're like, nope, we can't do it. It's just too big of a stage for the show I was going on to have a pre-earnings company featured, which I get. So I was like, uh-oh. So while Kyle was coming to meet me at the New York Stock Exchange flying from Texas, I had to come up with a quick on-the-train topic change, which I did. And then since then, the stock is up 25%. Yesterday, they announced a news with Tesla that they have a collaboration to get access to the miles driven in the vast Tesla database to go and streamline the automated insurance policy specifically for the FSD. So with the data that Tesla is collecting with full self-driving, Lemonade is going to be able to price in real time a cheaper insurance policy, particularly for those driverless cars, because at the bottom is, I think it says in here, a car that sees 360 degrees, never gets drowsy, reacts in milliseconds, can't be compared to a human. So this thing is huge. So Lemonade popped massively. Again, the insurance industry is 120 years old, massively ripe for disruption. And I'm telling you, some of the stories I've heard from my friends who have kids who are 16 and 17, when you put them on your insurance policy for cars, it's like $5,000 a year. It's insane. I wrote something to our clients. I'm like, I very easily could see Jake and Brody sharing a Tesla with full self-driving with a lemonade policy, and that's going to be I think much more safe for me and cost effective. So I've liked the idea of this company for a while, and the stock went from 80, 84, where we've been building a position in tag, added 1% on September 15th. I increased from 1 to 2% here November 20th on the pullback. Traded up to about 99. We're about 94 right now. This is a key technical level, the 786 retracement of the big 22 decline that I mentioned as the company is building up their systems. So like that one. That's your stock spotlight from Inside Edge. And we're also going to say thank you for joining us. Kyle, well
Yeah.
done. We hit everything, man. We had planning, fixed income, macro, technicals, earnings, stock spotlight. I mean, in 1 hour we hit a lot of things. What would you think?
Yeah, it was fitting. I haven't been on a stream in a few weeks. I missed doing it and missed everyone, so it was only fitting that we threw a ton in there.
Dude, you're so buried with planning with clients. I'm glad you came up for
Yeah,
air. I miss
it's
you.
good busy. Yeah.
Yep.
And I threw on my cricket shirt today
Oh, you look good, dude. There's your
with
Texas
the
cricket.
Willie Nelson head right here.
All right. We're going to post
Another
this
good
up.
section.
I got to bring my daughter to soccer. Snowstorm starts Sunday. Stay safe. Thanks for listening,
Yeah,
clients. Let
you
us know if
too.
we can do anything. Prospective clients, book a meeting if you'd like to have a call to figure out if we're a good match with each other. What you see is what you get. We share performance. We share our positions. Hard at work on financial planning. Kyle does a wonderful job. Our services, I would say, are on par with billion-dollar wealth management shops, and you get one-on-one attention. All clients have our cell phones. A lot of communication, and
Absolutely.
very proud of what we've done. So we'll leave it there. Anything else, Kyle?
Just let us know if you need anything, and we'll see you guys next week.
Awesome. All right, man. Have a good weekend.
You too. See ya.
See you guys.